Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago. Today is Friday, November 15th, and it was the highly anticipated WASDE day, the first WASDE report from September, and we did get some big movements in price action. Before we get into that, I do want to remind you, if you have not signed up for a free trial of our daily commodity commentary, head over to bluelinefutures.com, select the markets that most interest you, and we'll get it out to your inbox each and every morning. Now that we got that plug out of the way, we can go ahead and look into today's price action and what transpired with the USDA report. Looking at the grain markets, it was mostly higher week through much of the week. A lot of strong momentum, but big headwind today from the USDA, and overall price action gave a lot of that back. December corn futures at the close 11 1/4 cents lower, 4.30 1/4. January soybeans down 22 1/2 cents, 11.24 1/2. And lastly, December Chicago wheat down 8 1/2 cents, 5.27 1/4. If you're just looking at those numbers, you think that it was a terrible week. However, corn and beans still did notch a higher close on the weekly chart, which we've been referencing for the last couple of weeks. Corn was up about 3 cents, soybeans up about 7, and then wheat down just about 1/2 cent. Wheat continues to be the laggard there. Before we get to wheat, we'll go over the charts for corn and soybeans. Corn, you can see we broke out above the 200-day moving average in yesterday's trade, and it looked like all the momentum was there, and I think we probably could have seen some follow-through hadn't we had a USDA report in today's trade, but we did, and it really wasn't friendly at all. We had the national average yield come in at 186 bushels per acre. The average analyst estimate was for 184, so a disappointment there led to a break and close back below the 200-day moving average, which took us right to that 20-day moving average, which we referenced on Monday, being kind of the lower end of the support range. And we're going to want to hold that going into next week's trade. That comes in near 430, a break and close below there, and you probably see about another nickel of downside, which was the lower end of the range through the end of October. So if we can't hold and defend today's lows to start next week's trade, look for another nickel lower from there. I do think that we can probably continue to stair step higher and move past this report in today's trade. Now, over on the soybean side of things, it was an ugly day there. Had a breakout yesterday, but like corn, we got a USDA report, and it wasn't really friendly, and it wasn't not friendly. I guess the most bearish part of today's report was the fact that the flash sales didn't really show China showing up at a large rate. About 350,000 metric tons of flash sales during the government shutdown. Known to China, there was about another 350,000 metric tons sold to unknown destinations, which could be China. But all in all, I think the market was maybe hoping that China was going to be a little bit more prevalent within that flash sale data. When you're looking at the USDA, though, the yield 53 bushels per acre, that was below the average analyst estimate. Ending stocks for the United States below the average analyst estimate. World ending stocks below the average analyst estimate. So there were some silver linings in the soybean market. And if you look at this chart, it really just sets us back into this choppy range. The meat grinder range, I guess, is what I'm going to refer to it, that we've been in all month. That we tried to get out above there yesterday. Fell right back into it. And as referenced earlier in the week, that 1110 area, I think, is going to be pretty significant support. Below that, you've got psychological support at $11 and the 20-day at 11.01. Below that, and you probably start to see the tide turn a little bit more and the script get flipped. I do think this could be an interesting time going forward with regards to headlines. President Trump likes to be in control of the headlines, so I really wouldn't be surprised to see additional statements from the president, whether prompted by journalists or just on his own, about potentially, making good soybean deals with China. But those headline risks are still alive. They're not going to disappear. We've seen this not just in the grain markets, but other markets, the cattle complex, precious metals, stocks, etc. This administration knows how to work the headlines, so do not write that risk off just yet. Now, moving over to the wheat side of things, had a big move higher in the overnight trade. A lot picking up over in the Black Sea region between Russia and Ukraine. That put a pop in things. However, snap back to reality after today's USDA report. The world stocks number is just really, really tough to get out above and really write a bullish story fundamentally. Technically, we hadn't been able to participate in the rally that we saw in corn and soybeans, and with the bearish news today, the lack of technical strength, we saw weakness back towards the 20-day moving average. Below that, 50-day moving average near 520. Below that, there's a gap from October 27th. So I think there's probably still another 10 cents of downside risk here in the very near term. At that point, I think there could be a good risk-reward setup to the buy side. But for now, just kind of watching and waiting on the wheat market. I think there'll be better opportunities in corn and soybeans to come in next week's trade on both sides of the market, which I should add. A lot of debate on both sides of the market, bullish and bearish in corn and soybeans. And I think ultimately, I think some people get worked up about that, but I find that really, a breath of fresh air. We finally have a market where people are arguing their bullish and bearish case. And we hadn't really had that through much of the summer. I think a lot of people just kind of checked out. Volatility was dead, but that has since picked up. So things are moving. Opportunities are plentiful. Now over to the livestock side of things, we've got December live cattle pulled up here. Opened sharply lower, found our footing here, but again, marking lower highs and lower lows. So I think relief rallies are probably opportunities to sell into. The cash market, a little bit softer today. 5-area average on Thursday was 225. I think things picked up a little bit on Friday, but didn't really hear any confirmation. Then feeder cattle, same type of chart setup here. Lower highs, lower lows as funds continue to kind of hit the exit button. I think there probably will be some fundamental value, especially with those front month contracts being a little bit tied more closely to the cash market. Those deferred contracts, though, I think are going to be a little bit suspect, especially if we do get relief rallies. And in this environment, you could get bigger relief rallies amounting to 10 or 15 bucks, especially in this feeder cattle market, the way that we've been trading, really the lack of liquidity and things. So manage your risk accordingly there. And wrapping things up over on the lean hog side of things, just an ugly chart. We had a great start to the week and a terrible finish to the week. Right back at kind of a must-hold support area, 82.5 below that. And it looks like there's quite a bit of air underneath the chart. So wait and see on the lean hogs. Probably tread lightly in the cattle. Grains, it'll be interesting to see if we can't pull back a little bit more to start next week and present some buying opportunities to keep the trend of higher lows and higher highs intact. So that's what we're looking at. Hope y'all have a great weekend. If you have any questions at all, don't hesitate to reach out. And remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.